Hi, my name is Brenton Harrison, and today we're here to talk about Black-owned banks, how they work, and how your deposits can be used to multiply the impact of the money that goes into these institutions. Let's get started. While there have been a number of events in the past year that have brought increased exposure to some of the disparities that you see with how minorities are treated, recent events coupled with the financial impact of COVID-19 have also brought an increased spotlight to the importance of Black households and minority households having a strong financial foundation. Unfortunately, study after study has shown that not only are minorities more heavily impacted by downturns in the economy, but we also have a tougher time getting a financing for things like small business loans or even home loans. Study after study has shown that not only are minorities more heavily impacted by downturns in the economy, but we have a tougher time getting financing for things like home loans and small business loans. And even when we do have those loans approved, they're often approved at interest rates that are higher than those of our peers. You even see this disparity pop up in the cost of education, where not only do minority students leave school on average with more debt than their white peers, but that gap between the loan balances increases with each year after graduation. All of this brings us to the events of this past weekend, where Greenwood Bank, which is backed in part by Killer Mike, Andrew Young, Ryan Glover, launched their digital platform for their digital bank and announced that they have tens of thousands of customers who have already signed up wanting to open accounts when they formally launch in January. Greenwood Bank, which is an homage to Greenwood District in Tulsa, Oklahoma, which if you haven't read up on that, you need to, is a digital bank, and they're aiming to specialize in financing the needs of Black and LatinX entrepreneurs. And I want to read you a quote from Ryan Glover, who founded the bank, who in their press release stated that in order to build wealth, you need bank capital. We will identify qualified entrepreneurs, business owners, and creatives to equip them with the capital needed to make these dreams a reality. Now, to be clear, this isn't an endorsement of Greenwood Bank. I'm not going to tell you where to bank, but I do endorse Black wealth. And while it may seem obvious that banks need deposits in order to grow, you may not be aware of the multiplying effect that takes place when you deposit money into any institution. So what I thought we would do is I would walk you through that process of where your dollar goes when you put it into a bank so that you can see the economic impact that it has that can stretch far beyond the value of that bank's deposits. Step one is you deposit your money. Now, there's a reason that banks can't offer loans the very second that they open their doors. Deposits are the foundation of a bank, and the amount of deposits that they have actually dictates the loans that they can offer. So before they do this, they have to be what's called capitalized, which is essentially just a fancy way of saying that they have to offer and raise enough cash before they offer loans to make sure that they are safe and secure for their potential customers. Step two is the bank keeps a small percentage of your deposit on hand. Now, here's where most people's knowledge of banking ends, because you would think that if you deposited $1,000 into a bank, that they would keep that entire $1,000 on property. After all, it's your money, and if you want to go get it, you expect it to be there when you need it. However, most banks are not required to keep a large percentage of your deposits on hand at all. As a matter of fact, if it's a really small bank, they may not be required to keep any of your deposit on hand. But even larger or smaller banks or mid-sized banks may be required to keep just 3 or 5 or 10% of your deposits on hand at any given point in time. This concept is called fractional reserve banking, where they're operating off the concept that they don't have to keep 100% of your deposits on hand because it's highly unlikely that all of their customers would come and ask for all of their money out of their accounts at the same time. So they only have to keep a small percentage, and this concept is what allows them to offer loans that far exceed the amount of deposits they actually have on hand. So let's assume that we have a bank that's a decent sized bank and has a 10% reserve requirement. If you deposit your $1,000, this means that they only keep $100 of that money actually on hand, and the rest is sitting in the balance. Now, where does this balance go? Step three is the balance is loaned to consumers. Now, these loans could take the form of small business loans or car loans or personal loans or home loans. And these consumers take out the loans and they pay them back with interest that serves as revenue for the bank. This is a very, very important part of the cycle because as long as those loans are being paid on time with interest, it allows the cycle to keep going. Now, if you go to the bank and you ask for a withdrawal from your account that might exceed the amount they keep in reserves, they have all this other revenue from their loans that can be used to give you the money that you actually need when you ask for your withdrawal. You can also see why it's very, very crucial that it's paid on time, which are called performing loans, because if they're not paid on time, which makes it a non-performing loan, then everything goes out of whack. Now you might go to the bank and you might be asking for money that goes into revenues that the bank was counting on but hasn't received. And when you have a bank who has too many non-performing loans on their balance sheet, it puts them at greater risk for what's called a bank run. And a bank run is when the customers of that bank get word that maybe that bank is on shaky ground, or they hear a rumor that it's on shaky ground, and everybody runs to the bank and tries to make withdrawals that exceeds the amount of cash the bank actually has on hand at any given point in time. Now, you can also see why it's important that a bank takes the application process for their loans seriously, and that they do a good job of underwriting their loans to make sure that they're giving funding to people who are going to pay them back on time and with interest. Unfortunately, history has shown that as Black consumers, when we apply for these loans, we're more likely to be discriminated against or have more stringent standards applied to our application than those of our peers, which is why a Black-owned bank that aims to specialize in the financing of these needs is something that definitely piques the public interest. Step 4 is the loan is used to generate profits. If a bank has done a good job of underwriting their loans, then the money that they gave out has now been put into the hands of a business owner or a homeowner who puts that money to work in their business or in their personal finances and generates a rate of return that exceeds what they would have if they weren't offered financing. Let's discuss the multiplier effect. So we've covered the importance of bank deposits, and hopefully you now see that when deposits are made into an institution, it kicks off a process that allows this bank to grow exponentially faster than the value of just those deposits. And this is called the multiplier effect. It's the concept that when money is deposited into a bank, it generates economic activity that far exceeds what the value of those deposits might dictate. And there's actually a tool that people use in terms of the multiplier effect formula to give you an idea or an estimate of the economic value of the deposits that are made into an institution. The multiplier effect looks at the fractional reserve banking system and states that you can estimate the economic impact of a bank's deposits using the following formula. You take the deposits and you multiply it by 1 divided by the fractional reserve percentage required by that bank. Let's use an example of a bank with $50 million in deposits and a required fractional reserve ratio of 10%. We would take those 50 million in deposits, we will multiply it by 1 divided by 10% as the reserve ratio, and we would have a potential economic impact of $500 million. This means that the multiplier effect states that the potential impact of this bank's deposits is actually 10 times higher than the deposits themselves. And if you feel that you found a bank that aligns with your interest, it could be a potential impact in these economies that support areas that you feel are definitely worth propping up. I hope this video was helpful in showing you how supporting a bank that aligns with your mission can be impactful. As we strive for racial equality and equity in this country, it's really important that we understand how systems work and how the benefits and the impact of our efforts are felt by those on the receiving end. Talk to you soon.